point in which non-financial institutions are venturing into banking business. For example, you can find a company like the reason why I'm providing this, it might not like make sense because we are doing this question, but it will make sense when you encounter a question which is saying we have a company, a scenario which is having maybe assets increasing, operational efficiency is going down, and maybe annual turnover is going down. That's now when you see the difference between being able to make calculations and the ability to interpret a pragmatic business situation, right? So, as much as it is important to understand the calculations, it is also important to have the ability to interpret. I also do some MBA classes, and that's the reason why I want to also integrate with the ability to interpret, because it's not just about the ability to provide the metrics, but the understanding of how this situation can be managed, a strategy, how to develop a strategy from there. Okay, so I was giving an example of business moving from their core businesses to other sectors like financial service provision. For example, you can think in terms of a business like Shoprite. Shoprite is the biggest, largest retail firm in Africa, and one of the largest employer in South Africa. And recently, I'm sure a year or 2 years ago, it acquired a license to provide banking service. And today, it's just the lowest cost bank account, right? And it has been awarded, it was granted the banking license by the South African Reserve Bank. So we are seeing a trend in which credit management or risk management in the aspect of credit management is growing, because we are finding that Shoprite is also now maybe providing loans on its strategic business unit, where it's providing banking service. Macro, they're providing loans up to 250,000. So you find that credit management becomes very important even in universities. Maybe it's UNISA, it's Mancosa, it's maybe it's Regent. We also need a credit manager. So you find that it is important for you to understand the aspect of credit management, not just on a perspective of a person working in a financial institution, but we understand that many institutions deal with credit either directly or indirectly, right? Okay, so we are proceed with the question. We are a new credit manager for Mbani National Bank. An application of a temporary loan facility to bridge Mbani transport logistics, working capital requirements, lands on your debt. Consult the following, consult the information below to assist you in making an informed decision. I'll also explain something regarding industries, right? But let us read the table. Account, we've got inventory, we've got account receivables, and we've got payables. We've got the opening balance and closing balance for each. You can also just read the information that you have provided, and it will become an indicator of the direction of the business, right? Okay, for example, I say inventory, the opening balance is 23 million, the closing balance is 20 million. What we are seeing is that the inventory has declined by 3 million. We can see account receivables is 30 million opening and closing at 26 million. That's a decline rate of 4 million. Accounts payables, it was 22 million, it's now 24. We can see an increase. So what does this mean? Maybe to some extent, but it's not a clear picture or does not speak it all. But it's something that you can also pick that this company inventory is declining. I mean, what is the reason for inventory or stock decline? Accounts receivables are declining. What is the reason? Debtors, what is the reason? Maybe we are not selling much, or maybe we have the ability to collect our receivables quickly, or maybe something is wrong with our marketing. We are not pushing sales. Accounts receivables, accounts payables are increasing. This means also that we have increased those who we owe. So what can be this? What is this cause? What is causing this? Is also something that might be necessary for us to understand. Okay, Before we go too deep, I want also to explain that it's also important to understand industries, right? I was also talking about with the guys that we've been doing classes with, and I was saying that it's also important to understand industries, right? Because industries, you've got different structures and different characteristics. It's not possible that you can just compare Pick n Pay, ShopRite in cross country. I'm sure you see the trucks, cross countries you are driving, right? It's a big company, or a company like Wilson. Those are big, one of the big trucking companies. I'm sure some, I know that some which are bigger than them, but I also know Wilson have more than 30,000 trucks, right? Okay, we can say ShopRite is a big company. They can make huge sales. Maybe one shop can make 1 million, 2 million a day, right? But Wilson is different. Wilson might get money after a week because the truck is moving from Johannesburg to Harare. Maybe it's, let me just say it's 1,500 US dollars. Let's calculate in US dollars. It may be Wilson supplied 1,000 trucks, right? You find that this will be a lot of money if we convert it from US dollars to rand. But it's different with the ShopRite, because ShopRite is making sales every day, right? Wilson might even have 2 weeks without having loads, and it might seem as if it's not performing well. But maybe at the end of the month they supply their 3,000 trucks, and each truck is obtaining maybe 30,000 US. That would be a lot of money. Okay. And another thing that I also need to explain, the reason why I'm explaining this, it helps you when you're interpreting, even on item 2. When I'm explaining about the aspect of the transport industry, as an example, you find that the transport industry might have working capital challenges, right? Working capital challenge does not necessarily connote poor business performance. I once worked for a trucking company, right? And we could carry loads which are payable in 3 weeks, in a month, right? Depending on the business performance or the industry structure or the general environment, you might find that the loads might be scarce, and you can accept offers which with the man payable in a month or 2 months. You can accept that, right? You might have working capital challenges, but it doesn't mean that you are not making sales. It's just the receivables, when you're going to receive your payments, is just a bit longer. So when you're interpreting, it's not just a like a rule of that this company is performing bad. You also need to understand the industry. If you check when we were doing our classes, we talked about industries, industry risk. We need to understand the industry also before we make conclusions. Right. Okay, let's proceed now. Let's be fast now, right? Net sales during the year were 90 million. While cost of goods amounted to 60% of the sales. Interpret cash conversion. Interpret the cash conversion cycle in the industry. The cash conversion cycle. If the industry average is 85, so industry average is 85. So apart from the industry, right? Apart from the industry that we are saying, okay, the pharmaceutical sector is different from the retail sector, is different from the transport sector, is different from the mining sector in terms of the working capital and other areas of performance. Benchmarking is also critical. Benchmarking can be benchmarking within the industry or benchmarking with other firms outside the industries, right? But with similarities. Right? We can benchmark, maybe it's a financial institution. It can benchmark its performance with a company like ShopRite or with a company like Pick n Pay. Pick n Pay is not in the banking industry, but you can find a company benchmarking its performance with a firm outside the industry, right? But now we are having a benchmark within the industry. It also helps to speak the company performance in relation to the peers. So that can also tell that this company is not performing well. Because if we have an industry average and you are performing below industry average, it says something, right? Okay, let's proceed now. We're saying calculating by the transport logistics operating cycle and working capital, which is cash conversion cycle, right? One, and communicate your decision to the relationship manager and make your recommendation. Yes, you are provided 2 marks, but sometimes if you're provided 10 marks, and you do not understand interpretation, yes, you are told how to make calculations, and maybe you have somewhere to base your calculation. Say, oh, this was done here, but now interpretation needs your understanding of the calculation, right? So let's make the calculation. There are different ways to calculate this, as I know, but just for the sake of time, we can calculate. I can just lead in the calculation, but most of the times we need to interact. You will let me know how we calculate. So in this scenario, we have two things: whether it's theory or whether the calculations. Read the question carefully so that you clearly indicate and show your calculations. For example, this question 1 with 13 marks, you need to calculate operating cycle, and you also need to go to the working capital or cash conversion cycle. This question is also asked frequently, so we need to really understand. Okay, so how do we calculate the operating cycle? You can have the formula which you can just calculate once, but let's just think in terms of breaking it and calculate first the inventory conversion cycle. If there is someone who can give us the formula for the inventory conversion cycle, that will be nice. Okay, another question is, what is operating cycle? It's also important because if you just make calculations, we don't know what we're talking about, it becomes critical. What is operating cycle? Okay, so when you're talking about operating cycle, you also understand this definition as we're making calculations. So operating cycle refers to the days required for a business to receive inventory, right? Sell the inventory and collect cash from the inventory, right? Operating cycle is the time required or days required for a business to receive stock or inventory, sell that inventory, and collect cash from that inventory, from the sale of that inventory, right? I'm sure we are together. So we understand what is operating cycle. We buy our stock, the time we sell, we process the stock, we sell the stock, the time we need, right? Now let's break it and start calculating the inventory. I'm sure my writing is clear. If you're having any challenges, kindly let me. Inventory conversion period. We can calculate the inventory conversion period and we calculate the receivables collection period. So inventory conversion period, you're thinking of getting the stock, selling the stock. Receivables collection period, we are now trying to think the time period that we need to receive cash from the sales that we've made. So inventory conversion period is equal to average inventory divided by cost of goods sold. Then we can say O multiplied by 365 because this is in here in days, right? So we need to calculate the average inventory. Average inventory, go to A, item A here, which is inventory, right? We have opening stock is 23 million and we have closing stock is 20 million, right? Then if we divide by 2, here 23 plus 20 divided by 2, I'm sure we get 20 million. If I had mistake, let's just also calculate together, you can correct me. 20,500,000. Alright, that's our average. That's our average inventory. Right. So what we're doing, I would really ask you to pay attention so that patient can come exactly as it is, or just some few changes, like they can just come and put 50% here. Everything's the same. So it's also important to read the question, not just think, this is the same. Make sure that it's exactly the same. They can just come and put 80 million, but you just browse and check the question completely, then you miss the marks. All right. So that's our average inventory. Now let's calculate the cost of goods sold. Here we are told that net sales during the year 90 million, while cost of goods sales amount to 60% of the sales. So we know our sales. Now our sales here, our sales equal to 90 million, right? 90 million. And our cost of goods sales, cost of goods sold is equal to 0.6, which is 60%, multiplied by 90 million, which is equal to 0.6 multiplied by 90. We get 54 million, right? 54 million.
Hi, sorry to interrupt. The calculation of average inventory is 23 million plus 20 million divided by 2. Did we multiply it by 365 or are we
Oh,
still calculating?
okay. The calculation for average inventory, right? We are not multiplying by 365. Let me explain that. Maybe with Mrs. I might have been a bit fast. Okay. So you see what we're saying, operating cycle, right? Operating cycle, we broke it into parts, right? So on operating cycle, let me explain this. I think it's necessary. Operating cycle, we're saying operating cycle is equal to inventory conversion period plus receivables collection period. I'm not saying this is the only formula, but we can also calculate it one, receivables collection period. So this is the formula for operating cycle, and you're saying that the time period it takes for us to receive our stock, process it, and sell and get the cash. That's operating cycle, right? Then we are now calculating the inventory conversion period as part of the operating cycle, and the formula is average inventory divided by cost of goods sold multiplied by 365. But now we do not have the average inventory already, so that's the one we say let's come and calculate here, right? In other words, I'll show you how we can just do it at once, but I just wanted to avoid confusion. All right, so now the average inventory is the one that we've calculated here, and we found it to be 21,500, right? In this one, we are not multiplying it by 365. What you're multiplying by 365 is the whole formula for inventory conversion period. The average inventory is just a part of the formula, so we are not multiplying it by 365. Are we together there?
Okay.
Okay. Then now, since cost of goods sold is also not provided, okay, we also need to calculate cost of goods sold. So now we are calculating cost of goods sold, and we find it to be 54 million, right? And after that, we can go back to our formula and say our average inventory is 21,500,000. Then we divide by the cost of goods sold, which we found to be 54 million, multiplied by 365, like that. Then if we process this one, I'm sure if you press your calculator, you can get 0.3981 multiplied by 365. I'm sure we're going to get 145 days. So that's our answer, right? Are we together? Do we have any?
Yes. No, thank you.
Sure. Yeah, welcome. But let me also, even we understand, let me also show another way of calculating. Maybe some of us might have good calculators, and that's the reason why I recommend, I usually recommend the right view, because right view can do this calculation simply. For example, we can just take this formula directly. Average inventory. Yes, we can just say 23 million plus 20, right? Divided by 2, right? Then we can say also over 0.6 multiplied by 90 million, right? Multiplied by 365. If we've got these calculators which are programmed and like the right view, it can just produce the answer at once. right? But the reason why I broke down the calculations for us not to have much confusion. But if we have understand, that's fine, right? So that's the first part of inventory conversion period. So now let's calculate receivables collection period, so that we add inventory conversion period with the receivable collection period, so that we come to the final answer of operating cycle. Are we together? Okay. Just I could not. That is fine. We can just make our calculation on top here. Now let's calculate receivables. Receivables collection period. Receivables collection period, the formula is average account receivables right, divided by sales multiplied by 365, right? So that's what we have. So now we can proceed with our calculation, and we say our average receivables. We come to our receivables here, data that's 30 plus 26, right? So we can see just that's 30 million plus 26 million. Maybe we can just say divided by 2. Then we get our answer is what? 28 million. Right, I'm sure we're following. Alright, so what we've been just calculating is our numerator. Yeah, that's our numerator, the account average account receivables. So we have everything now because sales are already provided 90 million. So we go to proceed the final calculation. So it's 28 million divided by 90 million multiplied by 365. You can just press this at once and get the answer. Maybe you can just calculate the first part, 1 multiplied by 365. You are going to get your answer here is 114 days, right? And now to calculate the final answer, which is the operating cycle. You are saying now the answer that we got first, which was the inventory conversion period, we got 145 days. Then you are saying plus 114 days, and you're going to get 145 of 952, right? It will be 259 days. So we've calculated the first part, which is asking us to calculate the operating cycle. Do we have any questions on how we calculate the operating cycle? Okay, if we do not have the question, now we'll proceed to the calculation of the cash conversion cycle. Cash conversion cycle, or the working capital cycle. Okay, now what is working capital cycle or cash conversion cycle? We can calculate it by saying let me say working capital cycle is equal to operating cycle. I know those who do accounting easier to the accountants, but I know not everyone has got the accounting breakdown, right? Operating cycle minus accounts payable period or payment period, right? So that's how we calculate the last part, which is the working capital cycle. But already the operating cycle, we already have it. That's the 259 that we calculated above. What we are now looking is only the account payable payment period, or the accounts payable period, right? So let's calculate it. Accounts payment period, right? Okay, is equal to average accounts payables divided by total payables multiplied by 365. Okay, so now we can calculate the first part, the average. We can see that our accounts payable of 22 million, 24 million. So our answer is just 22 million plus 24 million divided by 2. Then our answer should be 23 million, right? The 23 million is the average. 23 million. My writing is changing. Okay, 23 million. Then we are saying average accounts payable that we've just calculated divided by total payables, which is 22 plus 24, right? Then that's 54. So we are saying 23 million divided by 54 million multiplied by 365. We are going to get 0.4259 multiplied by 365, depending on how calculated, and our answer is 156 days. If you're following the calculations and doing on your side, I'm sure you can get something close to this, right? So this is the accounts payable period, right? Once we obtain that, it means we can get our cash conversion cycle or working capital cycle, which we are saying that it's equal to operating cycle minus accounts payable period. And in this regard, that will be 259 minus 156. And our answer is equal to how many days we've calculated. That becomes 103 days. So that's our answer. Are we together on this calculation?
What is that number before 4259 by 365? Yes, what or zero?
Yeah,
Thank you.
0.42. We say 23 million divided by 54 and we got 0.425. Okay, are we together on this one? Okay, so another thing that I also need to mention, when it comes to these exams, I'm not saying another one is better than the other one. With 04, what I can also say, if you do your calculations, if you do your revision well, and also make sure that you have the memos, if we proceed to get on the revision, you find that 04 can be, you can finish it, you can finish on time, especially if questions are repeated, is usually happens. But sometimes it's just changing of figures, which you just need to have the concept. One exam that I also just need you to make sure that you are much conscious about time is 05. Because 05 also might require you to make sure that you take note of time, because the questions might require a lot of time, you know, those interpolations, like if they are there. Also checking the tables if you do not know values from the table, which is something that I also expect everyone to know from the page. Also, or just having somewhere where you write key normal distribution table for cumulative values. Okay, let's not talk about 05. Let's proceed with the other part. You say communicate your decision with the relationship manager, make recommendations. Another thing that I need to make sure to also mention when it comes to questions like this, when you make a recommendation, the answer is not one size fits all or a universal answer But yes, there are times when the answer can skew to a certain side, like yes, maybe, or no. But sometimes you find questions like this, they depend on how you explain. So in this case, the baseline of explaining this question is what is provided in the question. Let's also mention something. Remember, we've been provided the industry average. In that industry average will now act as a platform for comparison and giving advice. Also, we are told that the cash conversion cycle for the industry is 85 days, but we found the cash conversion cycle for transport and logistics to be 103. And cash conversion cycle, if the days are more, it means the company is not being efficient. Therefore, it means that the time period between getting the inventory, processing it, and selling get the cash is low, is small. And that's what we require as the company. Because we think in terms of many things like opportunity cost. If you get the money quicker, we can also put back the money into the business and buy more stock, sell it, making more money, or we can take it to other business, diversify, or other avenues, right? So I think in terms also of opportunity cost and even TVM, time value of money, a dollar today is more valuable than a dollar tomorrow. So it's better to receive our monies today rather than waiting maybe some more days from the industry average of 85. It therefore means that Mbani Transport Logistics is not operating much efficiently as we benchmark with the industry average or peers in the industry. But let me just also provide some recommendations. As the industry is a cash conversion cycle of 85, it means that on average, firms in the industry will take 85 days to convert their investment into inventory, accounts receivables, and back into cash. This indicator shows the industry efficiency in managing working capital and liquidity. When in transport and logistics, on the other hand, is a cash conversion cycle of 103 days, indicating that it takes the company longer than the industry average to convert its investments into cash. This shows that when transport logistics may have less efficient working capital management than its peers. Right. So the time gap between the industry CC and transport logistics is 19 days. 103 minus 85, which is the industry average. This disparity means that Mbani Transport Logistics takes roughly 18 days longer than the industry average to transform its investment into cash, which is not quite well. And what is the cause of this? Maybe we can think in terms of accounts receivables. Mbani Transport and Logistics may have a lengthier payment terms or experience delays in obtaining payment from customers. This could result in a long account receivable collection period, which will be detrimental of the CC. So if you also have poor collection, it means you are receiving money longer than you are supposed to, right? I also still remember this when we were saying working for this trucking company. It was not that big, and there was a time when I was doing the accounting, the part of the logistics and the like. They said that maybe with a list of payments, and there was nothing like a reflector or a something that will remind us, okay, this person said you're going to make payment. This some of the payments were collected as cash, and the companies might have a list of people they want to pay. So sometimes if you don't check with them, they can just keep quiet because they want also to have cash. So there's a time, oh, I skipped this payment. This person will promise that the payment is going to be made this and this date. So if it was a cash payment, not like they're going to make a deposit. If they're going to make a transfer, yes, they're just saying, okay, this day we'll make a transfer. But you need to collect, and we are the ones who are going there and collect the money. So you find that if you do not have an effective system of collecting your cash or for managing accounts receivables, you might have a longer cash conversion cycle, working capital cycle, just because of poor working capital management in terms of receivables. Also, this company might also have short accounts payables because in such a situation, that's when we are trying to think in terms of what we talk in market risk or in banking when we are saying maturity mismatches. Maturity mismatches, because you might have a situation when you, as the company, you are having longer or lengthier accounts receivables, right? You take time to collect your cash, but on the accounts payable side, you are paying your creditors too early. You've got short-term payment periods, right? For example, the trucking industry, it also needs more management, right? Why? Because when you want to buy fuel, sometimes you buy cash. We want to buy parts for the trucks, you buy cash. Maybe if it's not cash, maybe the payment period is just short. So it also needs to balance between the receivables and the payments. Your payments should not be, the payment period should not be that short and your receivables that long. In such a case, you might have poor working capital or cash conversion cycle. Alright. So to properly appreciate the significance of this comparison, an examination of the unique conditions of transport and logistics and its industry is very important. Factors such as industry norms, market conditions, firm size, and business model can all have impact on cash conversion cycle and its interpretation. To have a better understanding of transport logistics conversions performance, it will be good to research patterns over time and compare CC to that of industry competitors. Apart from that, it might be also necessary to uh, to check the previous performance of the company. Maybe the performance has been affected by other things and the company is in good shape. But what you can say in this scenario, that's when you're saying you do not have a one size fits all answer. You can also say, because of this, it's not advisable to extend credit to this company because it's in a poor condition. But someone can have a better way of also saying this company may deserve it, right? So that's what also mentioned in terms to say interpretation. Okay, from there, do we have any questions from this question number one?
Not a question, but I just would like to ask you to just scroll a bit up. I think I missed something at the very first portion of question 1.
Okay.
When you're writing notes.
Okay, we're writing notes. I think it's down here because I scroll down. Is it this page or the one above?
Just a bit further lower.
Lower, I'm sure there's nothing. If I'm correct, let me do this. Because my pages, the one that I wrote first is the last one.
Okay. No, it's fine. We can carry on.
Okay, but let me just do this. If you get the memo, you see, I was just doing, but this is the memo, right? So maybe you've missed something on calculations. These are the calculations here. Okay, wait. So might have been something, maybe something related to what I've been writing from the head. Maybe that one.
Okay. Yeah, I think I'm sorted now. Thank you.
Sure, you're welcome. And also, you're part of the revisions, right? You also have, if you have any challenge when you're doing revision, I'm sure I'll be available most of the times. If we have questions, ask on Telegram. Not waiting for next class. Okay. So
is this session recorded?
Yeah, it's being recorded.
Okay.
Thank you for that. Yeah, I know that most of the times, sometimes I forget to record the times because yeah, when I'm using Teams, usually we use Telegram. And when I'm using Telegram, usually away, but when we migrate to another app, so thank you for reminding. Then we can go to number 2. So you can see that number 2 is also not that difficult. Okay. So let's talk about probability of default. Probability of default, PD. Will explain how probability of default can help in credit decisions. 5 marks. So another thing that I will really need to advise that, okay, 04, I say that time you can manage and finish well. But with the 05, I would really recommend you to make sure that when a question is got 5 marks or 3 marks, do not spend time explaining a lot of things, because you can spend 20 minutes explaining, answering a 5-mark question theory, but below there are some other questions which you can score good, but you spend a lot of time on that other question. On these 3 questions, I would recommend you that to use the memo in particular, because I cannot write everything like the points under the probability of default. I'll just talk about them and we specialize more on calculations. What is probability of default? It's good to give the definition. The probability of default is just a statistical percentage. Probability of a borrower defaulting within 1 year term horizon, and it is used for allocation of capital, client selection, and credit quality monitoring. So just within the definition, I've also explained how it helps in credit decisions. Why? Because I said that it is also used in capital allocation of capital, client selection, and credit quality monitoring. Right? Probability of default is nowadays used in selection of clients, monitoring of credit quality, allocation of capital, as well as in better pricing credit risk. So it's also used in pricing credit risk. I also do the tutoring for financial management and international financial management. In financial management, both international and advanced financial management, we also talk about issuing credit to different companies, right? And we talk of what we call prime lending. I'm sure you know about prime lending. When you're saying that banks have got a special rate they give to their best customers, right? Or those business which are credit worthy, for example, multi-choice, or a business that is performing well, come to your bank and they're looking for credit. You don't just charge them high, right? But you charge them a reasonable interest, low interest, right? So we are now saying that if the probability of default is higher, it also means that the interest rate that you charge the client should be higher, right? You know what? It's also interesting when you broaden your knowledge in the field of credit risk, right? I still remember when you're doing credit, it was credit management, so it was just broad, right? So there's what we when we are dealing with the credit risk, there was also what you call the lemons problem. If you get time, just read around the lemons problem. It's also part of insurance, right? But we also say that medical insurance is least available to the people who really need, right? Guys, is it not right that we see a 90-year-old person coming for a medical insurance, and we have the sympathy to give them, right? But if we do that, we are just closer to the brink and the collapse of the business. Because if we give medical insurance to people of 90 years and above, or the people who worked in a mine for quite a long, or maybe in electricity, you know, I've been working just for a little in a company that generates electricity, that supply electricity. You know, there are other areas where the environment is not okay, it's just bad. So you need also to check the history of the person, right? So when it also comes to create the probability of default, we are trying to check the probability that this client is going to default. And the probability of default can also help in pricing the loan or the credit, right? Similarly to what I'm talking about insurance, we can't just accept anyone, right? What if we give insurance to the people who is already having some infirmity or some health challenges, or an elderly person? The probability that you're going to make payoffs soon is higher than just giving a credit to maybe a graduate who's just getting the job, and maybe an accountant or a risk manager of a particular company. It's different. So you find that the term is saying medical insurance is the least available to the people who really need it. If we are going to give them, we're going to charge them higher premiums, because the probability of making payoff sooner is higher than if we give a teenager. Similarly, probability of default is critical in credit pricing. If the probability of default is higher, then it means also the credit premium, risk premium, should be also higher. We need to charge a little higher. So we are saying that it is important to take note that the probability of default is widely linked to credit risk grades. The probability of default ranges from 0 to 100% in the event of a very high customer, right? Okay, so let's just look at few items related to credit risk, to probability of default. Probability of default plays a critical role in arriving at credit risk premium. So I was just talking about risk premium when I saying that when the default probability of default is high, then the credit risk premium should be higher. When you're talking about the credit risk premium, let me give you a simple example. When you're talking about credit risk premium, I'm not now very sure if this example will be quite well. Maybe might have others who are not doing 0.5, but let me just give it. Remember, when you're using the capital asset pricing model formula, we say it is equal to risk-free plus beta multiplied by market return minus risk-free, right? This portion, we call it market risky premium. Okay, so if we explain mixing the things, I'm sure it will help you sometimes to understand. What are we saying? Even in 0.4, you understand that we have what we call treasury bills. Treasury bills, government bonds, right? These securities are called risk-free instruments. Why? Because the probability that the government is going to default is 0, right? But also the return from these instruments are low, right? So I'm just explaining for you, maybe to understanding credit risk premium. So we're saying risk-free, we think in terms of treasury bills, government issued securities with the 0 or minimum probability of default, right? But we're thinking in terms of a customer. Let's say this is let me say it's Lisette has got 10 million rand. It's 10 million rand. She's thinking of investing the money. She can choose to invest 50%. Already we are talking about investments and portfolio management, right? Which is also part of this. We need to calculate expected return. We need to calculate standard deviation and the like, which we are going to do. Then she invests 5 million here. 5 million here. So what she's doing is that she's investing 5 million in government securities, right? Maybe treasury bills also there, and the return is low, but the probability of default is 0. Government cannot default, that's what we know, right? But you also take the money, the other part of the money, 50%, 5 million, you invest in a risk investment. You invest in the corporate world, the risky world, right? Maybe you bought shares for different companies, right? In that area, there's risky, right? Or maybe you gave someone a loan, there's a risk of default, right? And because of that, you find that the return that you expect on this side is higher than the return that you expect this side. Here the government, they can say, I'll give you 2%. You accept it because you know there is certainty of getting that 2%. Here you might look for 10%, right? You see, you look for 10%. And the difference between 10% and 2% is now market risk premium. Market risk premium. You can only afford, or you can only accept to put your 5 million into